Okay, so a second short video I'm going to try to pronounce much better. This is good for me to practice my English pronunciation. I watched my previous video and wow. So I'm going to try to speak more clear. So the last video was long and I explained to you something that's going to be hard for you to find anywhere else. So I hope you really appreciate that video. This one's going to be short and I just wanted to add something I forgot there. And we're going to talk about leverage. I'm not going to define it, first because it's going to make the video long, and second because leverage is something that's very well studied. So if you look information about it, you're going to find very fancy videos of people explaining to you, schools, they suck, they don't teach you what they have to teach you, they don't know. If they knew they were rich, they wouldn't be teaching. But they are very stupid, but they are not stupid enough to don't realize that they have to explain you leverage. So you will find leverage out there easily, what it is, how it works. Or what I want to speak to you about is that in the previous video we were talking about the different levels a price can reach. I told you that there could be like 10 different classifications, but to simplify we can use less. Then we explained that at the beginning stocks might trade high because people are excited, then we go down to little attention, to no attention, to little attention again, and perhaps they will go into the bounce level sometimes, okay, marked by their dividend, or sometimes the bounce level is marked by some people out there that if you tell them this stock isn't 10 cents on the dollar, they go and buy it, as long as it's profitable. So that's a bounce level generated by the common stock equity. You can Google that, what's common stock equity. You should learn about it if you want to be financially literate. And then the bounce level, also more simple to understand, is the dividends. The dividends create a bounce level, okay? But sometimes stocks pay no dividends, okay? So the leverage is very important because I told you that sometimes what you want to do is buy a stock when it has no attention, and then sell it when it has little attention for a profit, or you do like a process of realizing if the stock is good, because you don't want to sell great businesses, you want to sell good businesses that went up in price, okay? So if you check out the earnings reports or the news or whatever, a press release was out and the business is doing great, perhaps you don't want to sell it because it's going to keep going up in price, okay? This is just in case the stock is producing emotions, and people are stupid, they don't realize it's undervalued, but then the stock goes up 10% in a day and they get all excited and they start buying it. Sometimes that happens, and then the stock goes down again. It's something that happens. But what I wanted to say is that even if that sounds complicated and you end up understanding it, it's not as simple as that. It's even more complicated because different funds and different portfolios, different people and different institutions will decide to buy something based on the amount of leverage they have. And that's essential. Sometimes some companies or hedge funds or institutions, even if the stock gets into no attention and very undervalued, they will stay away of that stock because they are scared of it. And that's not because the stock is bad, but because of leverage. The problem with highly leveraged funds, if they are right and they are highly leveraged, they produce higher returns. But the problem is that you are scared of the downside, because the downside of the stocks can produce something that's called a margin call. And a margin call is when you have to deleverage. You leverage an investment and then you have to deleverage, okay? Deleverage is when basically your leverage provider, which many times is a broker, if you want to get the lower interest rates, I recommend you to use, for example, Interactive Brokers. This video is not sponsored. They offer very competitive interest rates. And for example, when the broker sees that your stocks are going down in price, they will do a margin call. And this is an automatic thing sometimes, or it's in paper, it's an agreement. So when they do the margin call, means you have to sell something. You have to deposit more or sell, okay? So if you have to sell securities, you don't want to buy these stocks sometimes because you're scared they might go down to the minimum price. So instead of going into a stock that has no dividend and has a risk of going to the minimum, some funds will choose stocks with dividends because they feel those will be more stable and will avoid margin calls. Because if a margin call comes in the wrong moment, then you have to sell stocks. And sometimes you might have to sell your best stock because you won't sell your stock at a loss. You will sell the stock that went up. So you will sell very good stocks you have that already went up to decrease the leverage and avoid the liquidation, the automatic liquidation of the brokerage or whatever. This is why some institutions that were highly leveraged, because they thought the securities were safe when the economy went down in 2008 and other crises, it was catastrophic because they were obligated to sell, and sometimes at high discounts. So the thing is that Can Capital, our fund, is very powerful because we don't use a lot of leverage. That sometimes might end up making us win less, but also it changes the behavior we have. When the leverage is low, you might have no problem buying these extremely valuable stocks because you won't be afraid of them going down, okay? Because you're fine. Then a second thing is that it depends on the situation of the portfolio also. It's very complex. Like some funds might have a portfolio where they diversified with a second stock or third stock, and that stock went up in price and is doing great, so it become what I call a price stable asset. So when they have a price stable asset in the portfolio and at the same time perhaps they don't have great expectations about that asset, like they're just holding it, they might have no issue leveraging, because in case they receive a margin call, they already have a stock that they know is price stable, and if they receive a margin call, they will sell that stock. In the previous video, for example, I told you my story with Petrobras. I did over 60% returns on top of the dividends, and 55 around that. I bought at 983 and I exit around 15 something. And the reason why I exited was to the leverage. I knew that stock was unlikely to keep going up. Perhaps it will continue going up, who knows. But I knew that I wanted to get rid of it. It was still a good stock, paying good dividends. I was happy to keep it. But if I received a margin call, I will deleverage with that. So at that moment, what I did is that I took a little bit more of leverage than what I usually take, because I knew I have something I can sell. But what happens when the stocks you have are slow stocks that might take 6 months, a year to skyrocket or to increase price? In that case, if the portfolio is going slow and everything is decreasing, then companies will tend to buy stocks that have dividends. Okay, they will change their behavior. So it's very complex. I realized that actually this one, I realized that not long ago. It's actually very complex. Sometimes not everybody wants the same. And sometimes a stock that pays dividends is going to be very valuable for certain portfolios because they are looking something more price stable. Okay, in a portfolio, you always want to have 1 or 2 stocks which are price stable and which can help you to deleverage. Okay, especially if times are rough. Right now, I don't do that so much because the markets are bullish. But if we get into like sort of recession environment or environments where things could go down, I will really want to have, I don't know, when I diversify 30% of my portfolio in more price stable stocks with good dividends, whatever. So in case markets go down and I have to deleverage, I can use those to pay my debt and have zero leverage. So when you have leverage, you can increase your return, but also you have debt. Then when you deleverage, you have zero debt, and then you can hold the stocks you have all the time you want. It doesn't matter if it goes down 80%, it doesn't affect you. Okay, you can hold that stock, it's not going to harm you. You can hold it, wait 5 years until it recovers, or it's a different type of portfolio. But you always want to deleverage if possible. Have the possibility of deleveraging so you can add a higher margin of safety, especially if you have more leverage than what I use, what Can Capital use. Can Capital uses low leverage. Sometimes we don't even get to 1.8. We don't multiply by 2 our earnings, little than that. We're very similar to Warren Buffett, actually. Warren Buffett didn't leverage a lot, and in that sense, we're different in a little bit of things. We also do value investing, but we use leverage too. And basically that's it. Also, situations where you want to deleverage is that if you are investing in valuable stocks that pay no dividend, sometimes the interest rate gets heavy. So you want to be ready to deleverage, because if you buy a very undervalued asset that pays no dividend and then the asset goes down in price, so you don't want to sell it, then the interest rate starts being too heavy. You want to have a stock that you can use to pay that leverage. For example, in my case, right now I'm diversifying with some companies in Mexico, and when I buy it, I take debt in Mexican pesos, and sometimes the interest rate is quite high. So compared with Hong Kong dollars or US dollars or euro, the interest rate in euros is quite low. So I really want to have a stock if I need it to get rid of my debt on Mexican pesos. It's like the first one I'm gonna pay because it's so expensive and so on. But that's it. That's basically the video today. So we were talking about leverage and how things are more complex than we thought. And the conclusion is always the same. Go into a partnership. You have 2 paths. Learn all of this yourself, or second thing, go into a partnership. Can Capital is a partnership. You could join us. You could join other partnerships. We help you to diversify. We help you to get more than one if you are lucky to get accepted and admitted. But the message is, if you find a partnership that does the job very well, go into it. It's very powerful. You have no idea how $5,000 put into a partnership can become a lot of money in your retirement. If the partnership is willing to keep you for 20 years, and they don't kick you out. But it's all like Harvard, I guess, and prestigious colleges and all of that. But that's basically the message, partnerships and understanding this. If you want to invest by yourself, my book is a very good choice, or you can read other books. My recommendation, again, as you know, I'm an expert in value investing. I don't specialize in shorting yet. I know a lot about shorting, but I'm not an expert like value investing. My recommendation is that if you cannot get into a partnership, better than mutual funds, better than getting into SP 500 or bonds, get books about value investing. You don't have to get mine. Go and get other ones and just buy valuable companies. Go for it. Buy undervalued companies right here, using no leverage, please, or just a little bit, 1.2, 1.4, no more than that, and just buy valuable companies, and you will do fine. Even if you have retirement accounts like a Roth IRA, all these great retirement accounts we have here in the U.S., those accounts don't allow leverage, so you will be fine. You just buy valuable businesses. That's it. It's much better. Diversify. Buy 5, 10, just to make sure to make your life easier, and enjoy your life. Enjoy your life. Have a relationship with 10 companies. It's funny. It's fun. It's something cool. You go. You check out the news. You check out how they are doing, and it could be fun. Why not? If you want to go serious, if you want to do the things right, get into partnerships. That's the last message I'm going to leave you. I'm not going to repeat myself anymore. Partnerships, 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 okay? So blessings, thank you for watching, and goodbye.